This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. A mixed open ahead for stocks as investors count down to a likely Fed rate cut later this month. A wave of Asian factory PMI numbers are set to kick off the week in this region. China's growth headwinds mount as factory and housing data worsen, suggesting that further government support is needed to hit the official expansion target. Plus, Israel's largest labour union calls a nationwide strike to pressure Benjamin Netanyahu into a Gaza ceasefire deal to free hostages.
This is a setup across Asia. After 3 weeks of gains for the Nikkei, we are seeing futures pointing to the upside of 0.25%. The Japanese yen holding steady was weakening for the past 3 sessions against the U.S. dollar. We're also watching the Aussie dollar because we saw incredible strength against the U.S. dollar. Of course, it was also a function of broad dollar weakness. We do have Australia's GDP numbers for the second quarter later in the week as well. We're also watching the offshore yuan at the highest level in about a year against the U.S. dollar. But really, as I said, it was really a function of dollar weakness. Take a look at the other side of the trade and what the dollar is doing now, because we saw, despite the fact that it was a big week of gains for the U.S. dollar on a monthly basis, it was still a big loss, given, of course, the uncertainty as well over what happens with Fed rate cuts to come. We will be watching U.S. futures right now pointing to the downside on a holiday Labor Day weekend. So investors will be away for a long break this weekend. But, of course, we saw those gains at the last few minutes of trading on the Friday session for the S&P 500. Of course, we have seen a lot of volatility on the S&P 500. The VIX actually falling towards that 15 level after surging more than 65 earlier in the month, given the market meltdown that we had around August 5th. We're also watching, of course, oil prices, given the rising geopolitical tensions in the Middle East and around Israel and Gaza. But Haidi, it will really be about those jobs numbers coming up later in the week. Of course, we do have the payrolls numbers. And now with more cracks being shown in the labor market, the core PCE price index that we got on Friday is so important. Are we seeing sustainable disinflation pressures in the U.S. economy? We saw core PCE price index gaining about 0.2%, which was a mild gain and perhaps really another indication of why Chair Powell talked about the time being right for those rate cuts to come.
Yeah, it still kind of underscores the sense of global fragility, right? Because even if expectations are still mounting that the US, the Fed, will be able to hit that soft landing, there are still global headwinds. And one of them is, of course, the big question mark over what happens in China. We've seen signals of government support. They clearly don't want to overdo it, but none of that has really translated to a meaningful improvement either on the industrial activity side and certainly not when it comes to the beleaguered good property sector. And this, as we take a look at kind of the most recent data suggesting that these growth headwinds are only mounting. Factory and housing data that we've gotten over the past few days continue to worsen. Economists are now saying that 5% GDP target is now in threat, that the government must do more. And of course, this is a big thing symbolically for China to be able to hit or exceed that growth target of 5%. It's very low for China, but obviously there are plenty of economies around the world that would love to have 5% levels of economic growth every year. The manufacturing PMI that we got posting a fourth straight month in the zone of contraction. We also saw the residential property slump deepening in August as well. The expectations of a further drop in new home prices are really hampering any kind of effort we've seen from the government to cushion the downturn. New home sales values of the 100 biggest real estate companies fell almost 27% from a year earlier, much faster than that almost 20% decline in July. So this sort of accelerating slide across data points in China suggesting that we will need to see more from Chinese authorities, including potentially from the PBOC and other fiscal measures as well.
Yeah, let's delve into some of the other data points that we need to keep an eye on. I mean, we were talking about the U.S. labor market. We're going to get more data on job openings, private sector job creation, and as we talked about, the monthly payrolls numbers. And all of these reports could give the Fed some insight into the need for further rate cuts after an all but certain cut this month. Also, Bloomberg survey of economists expect the U.S. to add 165,000 jobs in August and the jobless rate to fall slightly. And in Asia, I mean, Heidi, you were talking about the PMI numbers and the manufacturing data, but we're also going to get China's Caixin manufacturing PMI numbers, and those are expected to show an expansion. Later this week, we're also getting those GDP numbers out of Australia and South Korea as well. We also have a rate decision from Malaysia. We'll also be covering a slew of high-profile summits in the region as well, Heidi.
It's never a dull week as we kick off this trading week. Shery, let's bring in Carlos Casanova, Senior Asia Economist at UPP. Carlos, always great to have you with us. And we sort of position the two major factors for the global economy, right? Whether the Fed can stick this soft landing, whether China can kind of get its growth back on track sufficiently to be able to maintain that 5% GDP target. What do you think the risks are at this point? And do you think that there are sort of recessionary risks lurking for the US, even as the data continues to be quite resilient?
I would be more worried about the China side of the equation, to be quite frank. In the US, we have okay visibility. Of course, the disinflationary process continues, as we saw with the core PCE data last week. But this is going very slowly, and so we don't think that that inflation measure is going to be at the 2.5 level anytime before December this year. From December onwards, of course, lower inflation can pave the way for more rate cuts. But what the Fed is going to be focusing on for the coming weeks is the labor market and avoiding a correction in the labor market. That is why the numbers this week, including non-farm payrolls and the unemployment rate on Friday, are so important, because it will dictate whether or not the Fed is able to do 25 or 50 basis points. If we see a much stronger weakening in the labor market, which is not currently the consensus, then we could be in a situation where we are looking at a faster pace of slowdown in the US with the need for more preemptive support. But indicators remain quite mixed. So our house view remains 25 basis points and another 25 in December. No recessionary risks in the US, but just a slowdown that is panning out as expected. China is a bit more worrisome, in my opinion, and we are seeing weakness, across manufacturing and the housing sector. So that 5% growth target remains elusive, and we've maintained this 4.8 forecast since the beginning of the year. I would add that there's, if anything, there's downside pressures on that number.
I also think that as we get into the rest of the year, we've got, of course, the US election in November and potentially some fiscal risk and trade risk derived out of that. How do you think that impacts both the Fed's mandate and certainly complicates matters potentially for China as it tries to get the recovery back on foot?
For the US, I think the Fed is, of course, independent, but the Fed is not immune to potential market volatility, and so we do not think that it will be the best time for the Fed to cut rates around November due to the timing of the election. That means that if the US economy is indeed slowing faster than expected, September would be the time to do that preemptive larger rate cut. So on the US, definitely something that we're monitoring very clearly. Elections and other measures are going to impact the pace of Fed timing. And of course, depending on who wins the election, an increase in protectionist measures could challenge the outlook for rate cuts in the US if, trade tariffs, for example, result in higher imports, which in turn fuel inflation in 2025. So very important for the Fed indeed. For China, China is going to have to count on its domestic economy because they have to rebound or get out of the hole against a much more challenging external environment. It's not only in the US. We are seeing a series of other important trade partners like the European Union also follow suit, introducing trade tariffs. There's been a lot of concern around overcapacity issues in some sectors. We are even seeing that translate into weakness across the manufacturing PMI if you look at the subcomponents. And so I think it is a big issue for China in the coming few months, this overcapacity constraint and how to get out of the hole when you're not going to be able to export your way out of it as easy as before.
But Carlos, is it, as you said, an issue for China, or is it an issue for the rest of the world? Because I wonder about the global implications. Is it the concern for you that we will see the ripple effects across the world, or will it remain contained? Because every time China had a problem with its economy, they just threw money at it. Can we expect that again?
Well, the economist in the House is, of course, going to say that protectionist measures don't benefit anybody. So it is an issue for China, but it is also an issue for the rest of the world. So we do expect to see protectionist measures translate into stronger inflation. And, of course, this reshoring or reshuffling of global supply chains is inflationary in nature. And the U.S. consumer ends up paying the price for that. So definitely not in favor of some of those protectionist measures. For China, of course, they have been able to benefit a little bit from stronger U.S. demand in the first half of the year. Exports account for a much larger chunk of GDP than they used to, but that's going to start to phase out once U.S. demand normalizes in the second half of this year and into 2025. So for China, it's going to be imperative to lean on domestic demand and domestic consumption in order to stabilize growth at around 4.5 to 5%. And I'm saying 4.5 to 5% because it's a theme that overarches this year and also into 2025. And for that to happen, we need to see sentiment improve, and that is going to be very challenging in the absence of a recovery in the housing sector. So to your point, we are expecting a lot more support coming out of China. It's either that or they have to pivot on their GDP target for this year.
What are the likelihoods of that will happen?
Is being incredibly slow. I think everyone has a little bit of investor fatigue because we have been waiting since April for these measures to take place. And of course, the big political meetings over the summer, the July Politburo, and also the third plenum, were a little bit disappointing. The tone was correct, in line with what they have been saying for the past few months, but we lacked actionable measures. We do expect to see some of those measures coming in over the coming months. We do expect that they will expand the fiscal deficit target to at least 3.8% of GDP like last year, if not 4%. And of course, bond issuance has been very slow, both at local government, but also in terms of those ultra-long special government bonds that they are planning to use to develop a new infrastructure in China. So we do expect to see them expedite that a little bit, perhaps move some of the quota for next year into the fourth quarter. Overall, we should see a slightly more supportive fourth quarter for Chinese risk assets, but it is going to be very difficult to sustain that. They are being very slow, and there is not enough policy space to do big bazooka support measures like in 2009. So this time around, the low-hanging fruit is domestic consumers, and so there has to be a pivot at central government level in favor of consumers over sort of the emphasis on the supply side that has dominated policymaking in the past couple of years.
Carlos Casanova, Senior Asia Economist at UBP. Good to have you with us. Happy Monday. We have a busy week ahead. Coming up on the Asia trade, hear why Neuberger Berman thinks M&A deals are becoming more attractive in Japan. We'll also get more on the market outlook with MBMG family office and credit sites as traders await key U.S. economic data while China's growth headwinds keep on mounting. But first, Israel's largest labor group calls a nationwide strike as pressure from a ceasefire grows over the deaths of hostages in Gaza. Details next. This is Bloomberg.
Israel's largest labour group is poised for a nationwide strike on Monday. It is the strongest push yet to force the government into a ceasefire deal in Gaza. In what looked to be the largest protest since October, hundreds of thousands of Israelis demonstrated in cities around the nation on Sunday. That's after the bodies of 6 hostages were found in a tunnel in the Gaza Strip over the weekend. Bloomberg's Michael Heath joins us now. So, of course, tragic developments over the weekend, and you're seeing this kind of deepening anger within Israel that clearly they don't think the government has prioritised the safe return of these hostages and the remaining hostages.
Yeah, I mean, one of the crucial issues is, should Israel have troops between Gaza and Egypt? And Prime Minister Netanyahu is insisting on that.
This is the Philadelphia corridor.
Yeah, exactly right. And the defence minister and the military establishment are saying it's not critical if it helps us get a deal. But the cabinet voted in favour of the prime minister. So yeah, that sort of stuck there in terms of getting a deal. And so almost what we're seeing now is politics moving from Parliament to the streets to try to exert pressure on the government to get this done, because they're actually not far off getting a deal, it looks like. Though on the Hamas side, we're not sure where things stand.
I do wonder, because we've seen Netanyahu really proceed with the way that this conflict has been conducted, almost without regard for any kind of political pressure that's been building. Do you think these sorts of protests, as large as they are, the worst since October, the deep sense of dissatisfaction and hurt in the nation, does it make a difference in having him change his stance? Is there any political pressure on him?
It's difficult to judge, Heidi, from this distance, because he, in a sense, he's like every politician, he's looking after himself there, but he's sort of got the government and the parliamentary majority locked up. What's interesting is it's not just the labour unions, but business also was talking about joining in this action. So there's sort of a bit of a cross-section of Israeli society now that sort of enough is enough. The polls show that more than 60% of Israelis want a deal, only 10% are opposing it. And within the military establishment, various reports sort of show that they think now is the time for a deal as well, that it's not going to make too much difference militarily in terms of Hamas, but the possibility of getting these hostages who they've been there for almost 11 months now, it's a long, long time. And obviously these 6 who died, the Israelis say they were executed 24 to 48 hours before they were found. The Israelis sort of had an understanding they were in the area. So, it sort of also puts a lie to this idea that the military campaign can free the hostages, because it seems that Hamas's strategy is if there's any risks they'll be freed, they'll execute them. And so, the pressure has to be building on him to do that. And of course on the US side as well, they would desperately love a deal. So it's mounting, but then you've got Sinwar in charge of Hamas, who is in a tunnel somewhere in Gaza. Does he just wait out and allow the pressure to build on Netanyahu to get more concessions? It's very, very difficult. There's so many moving pieces going on here.
Any idea at this point how much of a toll this would impose, the strike, on Israel's economy?
It's hard to tell at this moment, Sharon. It's whether the airport is closed. The Ben Gurion airport, Israel's main airport. There's discussions there about whether that'll be closed the whole time or a couple of hours. And it depends how many come out. The finance minister, who's part of this very right-wing nationalist group, he's trying to get a court injunction to prevent Israelis from doing this. And he's sort of saying that public servants shouldn't do it. So it sort of depends what the reaction is. But as the pictures showed at the start, just the spontaneous protests yesterday, there were quite a lot of people out there as well. So there's probably a decent chance that it will be a good showing. But at the end of the day, Israel is a nation at war, so its economy is not in great nick as it is now. Whether this is not going to tip it over the edge one way or the other, it's more a political show, I think, than anything else.
Bloomberg's Michael Heath there with the latest on the Israel and Gaza war. And these are the other political stories that we're following. A new poll suggesting the Democratic presidential nominee Kamala Harris has erased most of Donald Trump's lead among likely voters in the battleground state of Michigan. The statewide Epic MRA poll of likely voters had 46% of respondents supporting Trump, while 45% backed Harris. The same poll in mid-July gave Trump a 7 percentage point lead over President Biden. German Chancellor Olaf Scholz's ruling coalition has suffered significant losses in regional elections. Parties on the extreme right and left took more than 60% of the vote in 2 states in eastern Germany. Media projections put the Alternative for Germany on course for the first win for a far-right party in a German state ballot since World War II, but it's highly unlikely to be able to form a government. French President Emmanuel Macron is set to hold talks with senior political figures as he prepares to name a new prime minister. He'll meet on Monday with former socialist Bernard Casanova and also plans discussions with conservative Xavier Bertrand. Macron may announce a decision in the next few days. France has been under a caretaker government since indecisive parliamentary elections in July. We have more ahead on the Asia trade. This is Bloomberg.
The X social media platform has gone dark in Brazil after an order by the nation's top court, and it follows Elon Musk's refusal to name a legal representative to deal with requests to take down alleged misinformation. Let's bring our global business editor, Karen Lee, for more. So, did we hear from the judge in terms of his rationale behind this?
We did, and we've also heard from Elon Musk, who's obviously not happy. He's lashed out at that Supreme Court judge on the platform already. But Heidi, let's take a look at what the judge said. This really caps a months-long feud between Musk and the Supreme Court justice who's been leading efforts to combat fake news in Brazil. Hate speech that he says is harming Brazil's democracy. The justice saying extremist groups and digital militias are using X to spread racist hate speech, saying the company has repeatedly and deliberately disrespected court orders. And really take a look at this language. These are fighting words. X has been contributing to an environment of total impunity and lawlessness in Brazilian social networks, including during the 2024 local elections. So this is really the end of something that's been going on in this court for a while, and now we're going to see how that affects X going forward.
Do we have an idea of how widespread the blackout is, and I guess the implications for X ongoing in Brazil?
Well, it's starting to go dark, but let's look at the context around this. I mean, Brazil is Latin America's biggest country. It's the world's 5th most online nation, has 20 million users in Brazil, and this is a huge hub for the company outside of countries like the US and Japan. So one of the things we're obviously going to be looking at going forward is how this impacts its users in the country, whether they turn to other platforms now. President da Silva is already among those bracing for the ban, tweeting at social media users the names of other platforms. Blue Sky from Twitter founder Jack Dorsey reported 1 million new users in the 3 days ending on Saturday in Brazil, tweeting a welcome message in Portuguese. The other thing to look at here is, of course, what this means for investment in the country. You already have Bill Ackman among the early criticizers of the court's decision. So there's a lot at stake here on the investment side, on the social media side for everyday Brazilians. We'll be taking a close look.
Global business editor Karen Lee there with the latest on X in Brazil. But take a look at how we're setting up for the opens across Asia. We, of course, have 3 weeks of gains for the Nikkei. We'll see if those gains are sustained this week as well. This as the Japanese yen holds at that 146 level. We saw some weakness against the U.S. dollar for the past 3 sessions. We had some broad dollar weakness for the month of August, but when it came to the last week of August, it was the best weekly gain for the dollar since April. We'll be watching JGB yields as well. They dropped the most this year. Of course, we continue to have uncertainty about the Bank of Japan's policy outlook. We'll be watching Sydney futures down 0.2% after we saw the ASX 200 gaining ground on the Friday session. We also had significant strength for the Aussie dollar and the Kiwi dollar against the US dollar last month. Take a look at US futures down 0.1%, but remember we're on a holiday weekend, so investors will be away in the US on Monday. We have more ahead on the Asia trade. This is Bloomberg. China's factory activity contracted for a 4th straight month in August. Officials are blaming the weak economic activity on bad weather. For more, we're joined by our China correspondent, Mimi Lo. So, Mimi, what do the August PMI numbers tell us about the broader economy right now?
Yeah, the August data was, at least for the manufacturing PMI, it was disappointing to the downside. And if you look at the past 17 months, we've only seen 3 months of expansion so far, at least since April of last year. The services PMI, though, looking slightly surprising to the upside. It was 50.3. The consensus was 50.1. The prior month was 50.2. But if you dig a little bit deeper into the services PMI, the sub-index for construction, that had slipped further, which suggests that construction activity is slowing down, and maybe some of that government support when it comes to infrastructure spending was slowing down as well. When it comes to manufacturing, if you look at the gauges for input and output prices, that has slipped as well, which suggests that weak demand is posing more deflationary pressures on factory gate prices. And you have the government saying that the weak economic data is because of bad weather, the hot temperatures, as well as heavy rainfall. But our Bloomberg economics team believes that there are more troubling factors at play here, because you have these local governments, reports of them maybe not being able to keep up with the expansionary budget set in March because of heavy local government debt. Goldman Sachs had written that so far, year to date so far, that revenue collected from taxes and land sales may not be able to meet the projected budget this year, which could weigh on government spending. And really, government spending this year is really one of the few levers left to boost the economy, given that private spending has really been extremely lackluster.
What else needs to be done then, impactfully, when it comes to housing?
Yeah, we have had the preliminary data for housing coming in for August, and it looks like there is a big decline in sales of about 26%, much bigger than the July decline of close to 20%. But in some ways, this wasn't unexpected because of some of those government measures recently. We have seen at least 10 cities either relaxing or scrapping those new home price guidances, which has led to many developers slashing prices, giving big discounts to attract buyers. And no surprises here that some home buyers are staying on the sidelines waiting for prices to bottom out. So home sales again going down for this month. And again, economists are calling for much bigger stimulus for the housing sector. We've previously reported that the government may be considering letting local governments use their special bonds to the funds from that to buy up those unsold housing. There are currently still about 61 million unsold homes in the market right now. And another measure that they're looking at, we previously reported as well that the government may be considering allowing homeowners to refinance their mortgages, about $5.4 trillion worth of those. But that's going to be equivalent to a mortgage rate cut, really. And it is going to be positive for the housing sector, but some economists say it's not going to be big enough to be a game changer.
Bloomberg's China correspondent Min Min Lo. They're watching out for the impact when it comes to Chinese risk assets as we get into the start of trading. We do have a sort of Asia PMIs as well to watch to see if some of that might provide a more positive foil to the dismal China data that continues to come in. Take a look at the setup as we get into this new trading week. Looking pretty cautious broadly. We're seeing dollar yen up about 0.25%. It was the worst month this year for the US dollar more broadly, but we did see an advance along with treasuries, as well as a little bit of more sort of risk on towards the end of the session on Friday, as we got really a pretty mild acceleration when it comes to the Fed's preferred gauge of inflation, as well as a pickup in household spending as well. Dollar China looking pretty flat at the moment. And let's get some analysis from Garfield Reynolds, who leads our MLive Asia coverage. So I suppose the question is, you know, if now the talk is what China potentially needs to do to hit that 5%, we've kind of seen China almost a bit decorrelated from broader EM that have managed to forge ahead regardless of the Chinese woes. What's most vulnerable here?
Well, it's one of those things where China doesn't seem to matter until suddenly it does. We'll see how it's going. The Australian dollar is one obvious potential area of vulnerability, because longer term there's plenty that can go wrong for the Australian economy if China is going to continue to slow down, and in particular if things like real estate is going to continue to get worse and worse and worse. For the moment, iron ore is still sitting at about $100 a ton. and that's just fine for Australian producers. But when you're going into a situation where we've got Australian GDP this week, that's seen coming in pretty weak. If it comes in weaker, if we start to get some concerns that the RBA's, as the Treasurer was flagging, the interest rates are helping to add to the burdens for the economy at a time when it faces other burdens, and if China's woes are seen as impacting Australia on top of that already weak GDP, well, then you've got the potential for those rate cut bets to really jump here down under. That should bring the Australian dollar down along with Australian yields. I also think there's a slow burn impact for Europe. We've got European stocks failing to really take off relative to the US, even though there was a lot of talk that once the AI bubble started to, at the very least, get some air taken out of it, that would help European stocks. Instead, there's a lot of concerns about Europe's economy. Germany in particular is showing a lot of economic weakness, and that's also translating into more political instability in Europe, all of which looms over European stocks and to a certain extent the euro itself.
Yeah, the far-right party on course to win a regional ballot for the first time. I mean, do we need to be sort of concerned about what that potentially does to the balance of fiscal policy?
I would definitely think that that's one of the concerns, and Europe faces this difficult balancing act. It's also got a war on its borders, of course. Well, potentially, I suppose you could say a couple if you want to include the Middle East on their borders. So there's plenty of instability there. That makes it hard to readily pivot towards any sort of stimulus that might be needed. There's the looming concern that with or without a second Trump presidency, Europe faces lots of need to increase defense spending. How do they fund that while maintaining the social contract? We've already started to see last week some concerns coming to the fore again in France, where during the Olympics people sort of relaxed about the fact that they don't actually have a government as yet. It's couple of months, or more than a month since the election. So all of those things hang over Europe. The concern about there's the need to bring fiscal policy to the party and get it lined up with monetary policy. Can they manage that in a more fractured environment?
But Garth, I guess also the broader question is there were a lot of hopes about the European stock markets because of their underperformance so far, given the rally that we saw in the US, especially among the Magnificent Seven. Could we see again that shift towards value, towards some bargain hunting, not only in Europe, but say in Asia? I mean, that's been the whole case for, say, Chinese stocks or Japanese stocks, right?
While Japanese stocks are facing their own potential difficulties with what's going on with the yen, the difficulty is that at the moment a lot of investors are still looking to the US. The US economy is holding up relatively well. The Nvidia earnings last week were disappointing apparently because they only hit expectations for very strong revenue and profit growth. So a lot of the sentiment seems to be you still look to the US, just maybe you don't look so closely at the Magnificent Seven. Bloomberg Intelligence was saying that the S&P index outside of the Magnificent Seven, so 493 other companies, earnings for that were good, best they've been in some time on a sequential basis, two straight quarters. So in that scenario, if you're looking for value, you might well look to the US outside of the Magnificent Seven, the rotation play that people were looking back at. I think the bigger concern for everybody is, what does payrolls bring? Remember, at the beginning of last month, we had this absolutely riotous sell-off that was partly created by concern that weaker than expected payrolls meant that the US was about to tip into recession. The Fed needed to cut rates by 50 basis points. All that faded away, and it's being treated as ancient history, mostly, by the markets. But we do have another payrolls coming up. You have to be concerned that strong downside or upside surprises could cause a lot of turmoil. So I think, to some extent, people are going to wait before going into EM or Europe or elsewhere in the US until we get a bit more clarity about what payrolls show, what that means for the Fed.
Yeah, we could see some sidelines trading right now. Thank you so much, Garfield Reynolds, who leads the Markets Live Asia coverage, focusing, of course, on that make or break number coming up, payrolls in the U.S. This is Bloomberg. Take a look at how markets are setting up for the Japanese Open. We had the Nikkei gaining ground for 3 consecutive weeks. The Japanese yen weakening a little bit against the U.S. dollar. Over the past few sessions, we're headed towards that 147 level. Now we're at around 146.45. And this, of course, as we continue to watch JGB yields as well, we actually saw the biggest drop in the most this year. We have, of course, uncertainties about the BOJ as well. One stock that we'll continue to watch what's happening around 7&I. A 7&I investor urging the company to engage with Couche-Tard and provide an update on the Canadian company's buyout bid by September 19th. U.S.-based manager Artisan Partners warned 7&I will be held accountable if it doesn't open negotiations. They add that the Canadian operator of Circle K stores is uniquely positioned to enhance shareholder value at the Japanese firm. Let's bring in our next guest, who's positive about the outlook on M&As in Japan. With us now is Kei Okamura, Senior VP and Portfolio Manager at Neuberger Berman. Great to have you here in the Tokyo studio.
Good morning. Thanks for having me.
Let's talk a little bit about this increasing interest on Japanese firms. Is it all to do with the Japanese yen being as weak as it is, or what's attractive about this market?
That is definitely an important factor, but I think it's sort of a confluence of many other factors as well. Like the deal that you mentioned earlier, there's a lot of interest for Japanese assets. And the public equity space that I'm looking at, I'm speaking to clients across the world, and what they're telling me is that they like the macroeconomic fundamentals that's improving. So you got the paradigm shift, the potential end to the lost decades of deflation. And then on top of that, you've got the capital management and corporate governance reforms that's changing the mindsets of many Japanese companies. You got the weak yen, and then, of course, associated to that are the weak valuations. Now, the topics right now is trading at around 14 times PE, 1.4 times price to book. Compare that to the U.S., which is around 20 times PE and 5 times price to book. So clearly there is that, huge opportunity that I think a lot of people are starting to look at in this market.
What are the messages that you're getting from the Japanese government and regulators? Because now we're hearing on that 7&I deal, at least, that the management could be asking for government protection. According to the Foreign Exchange and Foreign Trade Act, they want to be designated as a core company, according to sources?
Yep. Well, unfortunately, I can't speak directly to that deal. However, that being said, I can talk about the situation in general just because I do think that this is going to come up more and more going forward. Keep in mind that Japan, like the rest of the world, does have regulations, laws in place to protect national security assets. This is the same as the U.S. CFIUS is a great example. Now, we have been looking at the situation for the last several years. We work with the industry associations like the Asian Corporate Governance Association. We put out open letters saying, look, this has to be done in an open and transparent way. I think going forward, we are going to see cases like this emerge where there can be potential opposing interests happening at the same time. That being said, I think the message is clear. Japanese companies are open to do businesses. They are open to looking at various opportunities going forward. And keep in mind, last summer we had the Fair M&A guidelines that were revised by the Ministry of Trade that clearly states that all deals, transactions have to be taken into consideration for the sake of all minority shareholder interests.
Do you think if there is a decision made on this that could be perceived as protectionist, that it would swing, even as you say, sort of there's a neutrality to how perhaps governance and boards are starting to approach foreign interests? Do you think that would kind of from the outside swing opinion that perhaps not as much progress on governance has been made as previously thought in Japan?
I think, 15 years ago, yeah, I would agree, yes. But today, the situation has clearly changed. The economic fundamentals are completely different. The amount of pressure from shareholders to company management to get their capital efficiency higher and to achieve top-line growth, but domestically and internationally, has grown enormously. So I think going forward, we will see cases like this where there can be opposing interests at hand. But that being said, I think companies will still find out ways to form good alliances. M&As there definitely going forward, and I think this will be the case for the future of Japan.
How much of this has been down to the levels in the yen, and do you see this kind of window still being, even as the yen continues to strengthen, that it's still, is still a sweet spot, if you will, when it comes to sentiment?
Yeah. I think at the end of the day, the weekend does have an impact. I mean, just think about it this way, right? In the last month, we saw for the first time in 20 years, U.S. active investors turning overweight on Japan equities. This is a historic moment for Japan equities on that front. And I think it's not a coincidence that it's happened around the same time that the market has jolted by a significant amount, going back to 1987, I believe. So I think from that standpoint, the weekend absolutely has one point to play. And of course, the weak Japanese assets, especially in terms of equities, is certainly looking very attractive for global investors.
There has been a lot of optimism, as you say, on Japanese equities because of this optimism over the changes in corporate governance. I do wonder, though, how in line are these changes, not only among large corporations, but also the small and mid-sized ones?
Yep. In the last 2 to 3 years, there's been a huge bifurcation between large cap equity performance and small to mid cap equity performance. I'm not going to do a history lesson, but if we look back in the early 2010s, we saw something very similar. But after that, from 2014 on, for the next 4 years, we saw Japanese small to mid-sized companies outperform the rest of the market for 4 straight years. This is a very similar situation. You got reforms, weekend, all helping as a tailwind for large cap equities. That was the case for the last 2 to 3 years. Now look at it today. Things are reversing. The yen is appreciating. The domestic economy is breathing life again. This will be a good setup for the small to mid-sized companies. And not to mention, as you said, the reforms. We will certainly see more reforms that are coming from the small mid-size, because for the last 2 or 3 years, it's really been the large caps that's been sort of leading the pack on trying to improve corporate governance in Japan.
So you think this time is different from what you saw years ago? Because I think always the skepticism with Japan has been these starts and stops, optimism coming, foreign investors becoming interested and then leaving in just a few years later.
Absolutely. Look, I'm not going to say, everything's going to be perfect. I think there's going to be starts and stops.
Yeah, what are the risks?
The risk, obviously, is that, as you just mentioned, the regulatory issues, or for instance, we see a huge sort of decline in corporate willingness to address many of these issues. But as I mentioned, a lot of the drivers are now structural in nature. Japanese companies don't have this sort of second chance to go back to. I was speaking to regulators.
Are they feeling the urgency?
They are, and even more so, the regulators are feeling the urgency. They say this is the last time they have to convince foreign investors to look at Japan again.
Okamura, Senior VP and Portfolio Manager, great to have you with us. He's from Neuberger Berman here, dissecting the M&A environment for Japan. As we're getting breaking news as well, we're getting capital spending year on year for the second quarter, growth of 7.4%. Is an acceleration from the previous month, but it's also coming in slightly below expectations. And economists had expected growth in spending year on year of about 10%. Although when it comes to spending, ex-software, it's a beat and growth of 9.1%. We were watching this closely to see how Japanese companies were doing with capital investments. We saw in the first quarter that they actually trimmed some of those investments. This time around, we're seeing that they're coming in below expectations, but still an acceleration from the first quarter. Year-on-year growth of 7.4%. Catch Japan Ahead every Monday at 8:40 a.m. If you're watching in Tokyo, that's 7:40 p.m. Sunday in New York. And of course, subscribers can watch live on the terminal using the TV Go function. This is Bloomberg.
Latest corporate headlines for you. And Chinese automakers registered fewer electric cars across Europe in July. This as new tariffs amplified the impact of a broader slump in EV sales. Researcher Datafall says brands including BYD and SAIC Motor accounted for nearly 10% of EV registration. That is down slightly compared to a year earlier. New tariffs introduced in July raised duties on Chinese-made EVs to as high as 48%. Goldman Sachs is said to be planning to dismiss several hundred employees in coming weeks as part of its annual cull of low-performing staff. Sources say that would bring total cuts this year to around 3 to 4% of the bank's workforce. That is in line with Goldman's typical approach as it seeks to keep a lid on costs and make room to enlist new talent. Oasis fans rushing for tickets to the British band's first concerts in more than a decade, overwhelming the sites of Ticketmaster and other sellers. Fans complained of long lines and errors, with many walking away empty-handed after hours of waiting. The 17-night UK and Ireland tour is the first since the band broke up in 2009 after years of infighting between the Gallagher brothers.
I told you they were really popular. They're a classic. I didn't try to get those tickets, but I would be angry as well. These are the songs that we'll be watching at the Opens in Korea, Japan, and Australia. Yeah. Go ahead. Did you try?
No, Shery, I'm just thinking of one of our, young producers saying, I've heard of Oasis. I haven't heard their music, but I've heard of them. Yeah. We felt ancient after that conversation.
Oh my gosh, Wonderwall. Perfect road trip song. But these are the Asian chip makers that are in focus. Of course, Bloomberg has reported that Intel is considering options such as a split of its product design and manufacturing businesses, and Intel may reportedly consider selling its programmable chip unit Altera as part of a cost-cutting plan. Reuters also citing a source saying the company is also considering capital spending cuts, confirming a Friday report by Bloomberg News. And these are the markets. Overall, right now, a little bit of a mixed picture. We could see some upside on Japanese equities. We had the Japanese yen now holding steady at that 146 level. We're going to be watching South Korean stocks as well. Of course, we had 2 weeks of gains there, too. The market opens in Sydney, Seoul, and Tokyo. Our next, this is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. And of course, Haidi, this week it will really be about the August payrolls numbers in the U.S. Given all of the volatility after we saw last month's figures, the expectation right now is for a really sustainable growth in the labor market, also sustainable inflation we saw in the PCE core index as well.
Yeah, it was sort of a pretty well-balanced kind of set of data, right? And the household spending numbers picked up. So that sort of pushed back these expectations of a supersized 50 basis point cut. 25 is sort of what we're looking at. But Shery, we're also looking at the risk coming ever increasing when it comes to weakness in China, right? Data when it comes to housing, industrial production, PMI numbers continuing to look very weak.
Yeah, here in Japan, we'll be watching, of course, the market opens and where the Japanese yen is headed as well. We have the Nikkei now opening higher by about 1%, while the Japanese yen is holding at that 146 level. We had some weakness against the U.S. dollar, but we'll be watching JGB yields as well. They dropped significantly last week, given, of course, the uncertainty over where the Bank of Japan goes from here. We had second quarter capex numbers rising and accelerating from the previous quarter. These are the second quarter numbers, but also missing expectations. So we'll be watching those company investments very closely as we get wage numbers also out of Japan. So yes, really data is a driving force these days when it comes to broader markets. But take a look at how the Kospi is opening, because we also had export numbers out of South Korea returning to double-digit growth for the previous month. The Kospi gaining 0.3% at the open. We'll be watching the Korean won holding steady at that 1337 level. level. We do have inflation numbers on Tuesday for South Korea as well. Of course, very important whether or not we return to that 2% inflation target by the BOK, Heidi.
Yeah, those macroeconomics in focus for Australia as well. We were talking about the malaise in Chinese property continuing. We're seeing the Aussie property starting to heat up again. We did see that ongoing imbalance between supply and demand really continuing to play out with that acceleration of higher prices across capital cities here in Australia in the month of August. The pace of gains, though, has moderated. Some of that affordability constraint is still starting to play out as well. So we are watching when it comes to the impact of the poor China data on some of these risk assets in Australia. Aussie dollar holding actually pretty steady, 67.67, even as we saw that broader recovery in the US dollar, of course, after the USD's worst month for August. That was the worst month this year, I should say, but we did see that sort of modest advance along with Treasury yields after the preferred measure of underlying inflation for the Fed came in at a pretty mild pace there. Australian bonds at the moment looking like we're seeing a little bit of softness there. We're also seeing that fall in Kiwi debt early on in the session there as well. Really tracking the same sort of trend that we saw in US 10 years as well as, of course, over in Germany as well, where markets are pairing expectations of easing from the ECB. Taking a quick look at oil, we're seeing downside of about 0.75%. There are signs that OPEC Plus output is going to be boosted. Some of the demand woes out of China also weighing there as well. OPEC Plus is set to add 180,000 barrels a day of supply in October, and that just compounds those woes as we saw factory activity in China shrinking for that fourth straight month, Shery.
Heidi, let's bring in our next guest, Paul Gamble's founding partner at the MBMG family office. And Paul, I want to get to China, but I want to start with a potential risk this week. How prepared are you for a potential market meltdown like we saw when we got the July payrolls numbers?
Yeah, good morning, Shery. So I think, we've been worrying about that, getting ready for that for some time now, because we don't quite know, what's going to trigger it. We've seen these vulnerabilities gradually building up in the system, and they just seem to be getting worse and worse. Our expectation actually is that maybe the markets can make it to the end of next year, and it's probably 2025 that's the really dangerous time. But we're definitely seeing a significant systemic slowdown across most aspects of developed economies, particularly the US. We've seen relatively weak, data for some time coming in the employment side. If we look at hours worked, we look at job openings. Therefore we start to look at employee remuneration as well. It's actually been a picture that's been looking weak for some time, but people have been kind of holding their nose and looking the other way. So. If we start to see, sustained data points that really reinforce this weakness, then that market reaction could come a lot sooner than we think. But our best guess is next year, but nobody knows for sure what the timing on that is. It's not something you can play the timing on.
When we're talking about sustained weakness, of course, that's something that we're clearly seeing in China. The question of the day today: what assets are vulnerable to Chinese slowdown?
Yeah, so look, that's a really interesting point, and I think what we have to remember is when we see some of the weaker data that's coming out of China, we have to remember that a lot of that is probably the best way of actually understanding Western data, because obviously if we look at the trade volumes, that's where it's really getting hurt, and obviously we haven't yet seen the Chinese authorities pull off successfully this transition from export to domestic consumer driven. But we're actually a lot less worried. We're still a lot less worried about China than we are in its own terms than we are about the States. So again, we see China whenever we see weak PMIs, manufacturing coming out of China. That just reinforces to us the view of just how weak the U.S. economy is. And I guess what we're seeing is a very gradualist approach from Chinese authorities to completing this transition and to stimulating that transition. And to us, that kind of we think they've probably got a better handle on what's going on in their own economy than, for instance, the Fed or the Treasury have in what's going on in the U.S. economy. So we never fully trust policymakers because historically they make mistakes. But we've probably got more faith, even despite the weak data out of China. We've probably got more faith that Chinese policymakers really have got that one under control than we have in the States.
What do you like in China then? Tech in particular is compelling?
Yeah. I think so. I think the tech story, and ultimately, you've got to remember that when you're looking at China, this is because the approach is very gradualist, it's very long term. Then you're going to be set up for an awful lot of disappointments on the way. But if you've got a long term view, or if you're prepared to trade those dips and bounces, then I think tech is Chinese tech is potentially a great story. I think a lot of the consumer stories as well are also very, very compelling. And of course, there is that huge intersection because we've got so much e-commerce. You've got that huge intersection between consumer and technology, and that's an area where bargain hunters can definitely go looking right now. As I say, if you're an investor, then it's very, very much a long-term proposition, just adding on weakness and lightening on any strength. But for traders, it's a fantastic market. There is so much volatility in that market.
How much risk appetite do you need to have, though? Because we know that, a lot of things in China can turn on a dime, but the reality is that they're in the middle of a pretty prolonged structural slowdown, and I would hazard to say that policymakers are actually quite comfortable with the structural elements of that slowdown because property, for example, was an issue that for a long time needed to be deflated.
No, that's exactly right. I mean, we're not going to see, policymakers rush in to support the market. So you are going to be, as I say, for an investor, you're going to have to live through some pain. It is very, very much a long-term process. And just to be clear, it's a pretty small part of our portfolios. We saw throughout Asia that some allocators were getting a bit carried away with the China story a few years ago and way over allocating Chinese equities to portfolios. This because of the amount of risk that's in there, as you rightly point out, this really needs to be a pretty small exposure if you're going to take a long only exposure to China. From a risk point of view, definitely be very, very careful. It's just that as a small component, as an interesting story to just tweak a bit more alpha out of portfolios, being able to add a small China component and being willing to, as I say, trade in and out when we get these really big moves up and down to increase or decrease the position. It's one of the most compelling value propositions that's out there. But it will definitely be a situation where policymakers are very much looking at the long term, and I don't yet think they've got the property side under control. I think they want to see more air let out of that particular bubble. But I think the fact that they're managing it just shows that this is very, very much a long-term process. There's no way we're going to see pursuit of growth at any cost in Chinese policy. Whereas I think the interesting thing is if our thesis that the West has slowed more than policy has reacted to, we're going to see a really interesting policy response in 2025. We're going to see massive policy responses from Western policymakers.
Paul, given the risks that you're talking about, whether it's in the Chinese economy or the U.S. economy, could we expect more safe haven bids for the Japanese yen? I mean, we haven't seen the sort of strengthening in the past couple of years, but given the BOJ policy shift, will this now be the time where you'll be buying yen?
Absolutely. Well, we were buying yen when it was at 160, and in fact, all the way from 150 to 160, we were buying yen. I think the really interesting thing that we saw in August was obviously when we saw the yen spike. I think most commentators, ourselves included, expected yen to give some of that back. We thought yen would run all the way back to 150 before the next bout of yen strength, and I think on an intraday it just about touched 150, but that really didn't hold, and now it seems like it's strengthening again. So I think perhaps the worst of the yen might be behind it now, and definitely as a safe haven bid. definitely is an interest rate differential play as well, because even if some of the Japanese data disappoints and Japan cuts, we don't expect the level of interest rate cuts from BOJ that we expect the Fed to have to make when they correct the fact that they're too far behind the game. So yen, I think, is probably one of the best value havens out there. Treasuries, of course, remain a very good haven. We were, the third kind of defensive arrow that we had in our quiver was gold and gold miners, but we've largely sold that off because the rally in gold, it may still have a lot of legs to go, but certainly relative to yen, relative to treasuries, gold now looks like it's overdone. We're expecting that it will hand the baton over to yen and over to treasuries from here on.
Paul Gamble's good to have you with us, founding partner at the MBMG Family Office Group. Take a look at some of the movers across the Asian session. We're watching those chip makers after Bloomberg reported the news on Intel that sent the share spiking. It's discussing various scenarios to navigate the current challenges, including a split of its product design and manufacturing businesses, not to mention which factory projects could potentially be scrapped, according to people speaking to Bloomberg. So we're just tracking the semiconductors across Asian trading. A little bit of a mixed picture, Heidi.
Yeah, still ahead, Shery. CreditSights joins us to discuss the latest gloomy economic signals out of China, including the potential refinancing of $5.4 trillion of mortgages. But first, Israel's largest labour group is poised for a nationwide strike as domestic pressure for a ceasefire and a hostage deal builds. This is Bloomberg. Israel's largest labour group is poised for a nationwide strike on Monday. It's the strongest push yet to force the government into a ceasefire deal in Gaza in what looked to be the largest protest since October. Hundreds of thousands of Israelis demonstrated in cities around the nation on Sunday. That's after the bodies of 6 hostages were found in a tunnel in the Gaza Strip over the weekend. Bloomberg's Michael Heath joins us now. So an enormous amount of grief and anger and the running out of patience, not just, of course, domestically, but certainly we're hearing from the US as well.
Yeah, I mean, there is a real sense of that, I think, Heidi, and the tragedy also being that these people, it seems, were executed. These hostages were executed 24 to 48 hours before they were found. So there were probably troops within proximity, which sort of undermines Prime Minister Netanyahu's argument that the best way to free the hostages is to win the war or to defeat Hamas. Because if Hamas is going to do that, then you're only going to find dead hostages, which, is sort of a tragic situation. But it looks like the Israeli public has sort of realised that it's one thing, they've said in polls that they're for this, but then they've got a government which doesn't face any sort of imminent election. It has a majority, a fairly solid majority in the Knesset, with these sort of right-wing ministers who have their bloc on side. So it sort of feels like it can just do its own thing. And for Netanyahu, that's just pursue this war to the end, keep the right wing on side. So it looks like politics is going onto the streets now with this labour union calling the strike and the protests we saw yesterday. So it looks like sort of quite an escalation within Israel.
Quite a difficult situation for the US as well, right? President Biden obviously outgoing, Kamala Harris pressure to take perhaps, a more humanitarian-focused approach, because it's not just about these hostages, their families, the ones that remain, and their fates, but also the 40,000+ fatalities on the other side. Yeah, I mean, it's just the whole thing is just a tragic. It's just horrible. There's no other way to sort of describe it. But yeah, I mean, how Kamala Harris handles this is going to be really quite interesting, because as much sympathy as the US has for Israel, that doesn't necessarily extend to the government of Israel. Israel isn't just its prime minister and its cabinet at this stage, and I think that there's probably a lot of frustration and disquiet in the US about how they're handling that. So yes, I mean, with Biden, you can just see that he was just heartbroken that this the Israeli-US hostage who was found dead, and they were so close to releasing him. And there was a report in the Washington Post that was saying that there's sort of
negotiators have sort of had enough, and they're going to sort of have this take it or leave it deal on the table. So yeah, I mean, it's hard to know where we'll go with that.
And we've also heard, of course, of the challenges, economic hardships that Israeli people are suffering now, given the really prolonged conflict with Gaza. What can we expect in terms of economic impact here for Israel?
Yeah, Shery, I mean, it will. If it depends on just how far the strike extends. But if it is, if they do shut down the country, it's obviously going to be reasonably significant. And businesses also. I mean, just to give you a sense that this is not just Labor-led. This is a wide set strata of society. The top 200 businesses were also talking about joining this action. But it also depends on how, it might be more symbolic. I mean, with Ben Gurion Airport, the largest airport in Israel, there's talk that maybe it'll be open for maybe it'll be shut for a couple of hours, or maybe there'll be rolling strikes. People aren't quite sure. So we'll really have to see how that unfolds. But Israel's economy is obviously, it's not in great shape. I mean, they've been fighting a war for 11 months, which is obviously very, very expensive, and it stops a lot of economic activity at home as well. And we're not even looking at what's going on in Gaza and the Palestinian territories in the West Bank as well. So yeah, look, economically, it's not good for anyone. But until basically the war comes to an end, this is going to be costly financially and economically for all involved.
Mike, any updates when it comes to the tension spreading to neighboring Lebanon, the West Bank as well?
Yeah, look, I mean, there's been an escalation in the West Bank in terms of Israeli troops sort of targeting militants there, and not so much with Hezbollah at this stage. So there was a lawmaker I was reading about on the weekend who was sort of complaining that Hezbollah has sort of drawing Lebanon into this conflict without any acknowledgement by the state there, or any the wider Lebanese society not having any control over that, and that its actions really are doing nothing for the Palestinians. It's firing off all these rockets. The conflict's continuing, and they're probably going to draw down potentially a lot of Israeli response on innocent Lebanese there, which is a really good point. I mean, Hezbollah is sort of a state within a state in Lebanon. They can't control it. And again, so yeah, the wider region is really, obviously, it's always worth watching, because that's the real concern beyond the tragedy that we're already seeing.
The pace of terrorism across the region has kind of been in relative decline in recent years, right? Is this a real threat that this conflict, this kind of revives the risk of extremism? And certainly, if you take a look at what's happened in Gaza, there's that real risk of how much it's radicalising more generations.
Yeah, I mean, look, you could say that logically the entirety of the youth of Gaza, of children of Gaza, if you're raised in war and a breakdown of services and this sort of thing, and we've seen this all over the world, that where there's civil strife or conflict or whatever, people aren't raised in normal environments of going to school or anything like that. All you know is weapons and violence and the struggle, basically. So the notion, particularly in Gaza, of that being the case, but also on the West Bank, where because of this right-wing government, settlers are sort of emboldened, and there's a lot of attacks on Palestinians there as well. And yeah, I mean, similarly, obviously with Yemen and the Houthis, and so that whole axis, the more that war begets war in that sense, and the radicalisation, no doubt, is going to worsen as a result of the conflict.
Thanks, Michael Heath there with the latest. More ahead on the Asia trade. This is Bloomberg. Hong Kong Finance Secretary Paul Chan will visit Sydney and Melbourne this week in a bid to sell Australian companies on the future of the Asian financial hub. Bloomberg's Paul Allen joins us now for more. So what's on the itinerary for Paul Chan, and what does he want to sort of cut through with his message here?
Well, he'll be giving a couple of speeches while he's here, one to a major business summit, another to the Asia Society of Australia, and he's looking to attract investment in emerging industries. So Australia already exports a lot of food, particularly wine, to Hong Kong, but he's looking to diversify that, move into new energy, fintech, biotech, and he's emphasising Hong Kong's world-class universities, research, etc. And he describes Hong Kong as a two-way gateway connecting the Chinese mainland and the world. So that's really the message that he's bringing.
How's it being received?
barely raising a pulse at the moment, and you wouldn't know that he was here if you were only looking at local media. This might change, of course, when he delivers his addresses, but you've also got to wonder how receptive the audience is going to be to these messages. The Australian government's got a travel advisory in place against Hong Kong at the moment, what's called an alert to exercise a high degree of caution, and it's all around the national security law. The advisory says that can be interpreted broadly. You could be detained without charge, denied access to a lawyer. So when you consider that context, you've got to wonder how receptive the audience is going to be to this message.
Bloomberg's Paul Allen there. And these are some of the other stories that we're following from around the world. A new poll suggesting that Democratic presidential nominee Kamala Harris has erased most of Donald Trump's lead among likely voters in the battleground state of Michigan. The statewide Epic MRA poll of likely voters had 46% of respondents supporting Trump, while 45% backed Harris. The same poll in mid-July gave Trump a 7 percentage point lead over President Biden. German Chancellor Olaf Scholz's ruling coalition has suffered significant losses in regional elections. Parties on the extreme right and left took more than 60% of the vote in 2 states in eastern Germany. Media projections put the Alternative for Germany on course for the first win for a far-right party in a German state ballot since World War II, but it's highly unlikely to be able to form a government. French President Emmanuel Macron is set to hold talks with senior political figures as he prepares to name a new prime minister. He'll meet on Monday with former socialist Bernard Casanova and also plans discussions with conservative Xavier Bertrand. Macron may announce a decision in the next few days. France has been under a caretaker government since indecisive parliamentary elections in July.
Take a look at how European futures are opening. Of course, quite a lot of political volatility that we're sort of bracing for there. German DAX futures actually looking pretty steady, about a 1/10% higher there. It is looking pretty flat more broadly. But of course, we've had this surge of populism in Germany's regional elections. Really a humbling moment for Chancellor Olaf Scholz. A ruling coalition punished across 2 regional votes in eastern Germany on Sunday. We saw populist parties there on the extreme right and left taking more than 60% of the vote, almost half in Saxony as one example. So we are seeing, some of that potential implications when it comes to fiscal policy making and highlighting the risks that the broader coalition facing going into the national election due in just over a year. The economy has been stagnating. Migration is on the top of voters' concerns. So we are seeing that political instability play out. More ahead on the Asia trade.
A bit of a mixed picture across markets in Asia. We're seeing the Kospi falling about 0.5%. We're talking about consumer discretionary and communication services leading the declines. This, of course, after 2 weeks of gains for the Kospi already. In fact, when it comes to the Nikkei stock market, also 3 weeks of gains and extending those gains in today's session. Information technology and materials leading those gains in the Nikkei index. When it comes to the ASX 200, we're seeing some downside as well. We had gains for the Friday session and also a very strong Aussie dollar against the US dollar. Of course, broad dollar weakness was a theme in the month of August, the worst month when it comes to this year for the greenback Haidi.
Yeah, and of course, there's a lot of headwinds as we head into the end of the year, particularly when it comes to the question mark over whether China's slowdown is going to really play out in a more serious way for economic activity across its Asian trading partners. Take a look at the Asia PMIs that we're monitoring at the moment. Of course, this comes on the back of the weakness that we have seen when it comes to factory activity in China. It is a mixed picture. We're seeing Japan, where really the recovery has been on foot, but it's steady going, right? We're seeing still under that 50 level that suggests contraction. We're seeing South Korea seeing some strengthening, as well as the Philippines looking pretty stagnant at this point. Taiwan pulling back a little bit, and we're seeing a little bit more weakness from the likes of Thailand and in particular Indonesia also falling further into contractionary territory. And as I mentioned, China's factory activity, Shery, contracting again in August.
Thank you.
Yeah, officials are really blaming the weak economic activity on bad weather. For more, we're joined by our China correspondent, Min Lo. So, Min, what do the August PMI numbers tell us about the broader economy here?
Yeah, the manufacturing PMI missed expectations, coming in at 49.1. The expectation was 49.5. And look, over the last 17 months, basically since August last year, we've only seen 3 months of expansion when it comes to manufacturing PMI. If you look at the services, that has slightly surprised to the upside, 50.3 versus expectation of 50.1. The prior month was 50.2. And officials are saying that the services PMI was really boosted by the summer travel season because school children are on holiday. But if you dig deeper into that construction sub-index, that has slowed down. It's basically at the weakest we have seen since February of 2020, which suggests, again, building activity is slowing down and perhaps the government support in the form of infrastructure spending also going down. The manufacturing PMI is below expectations for the 4th consecutive month. And if you look at the gauges for input and output prices, that has slipped as well, suggesting that we're seeing this persistently weak demand, which is putting more deflationary pressures on factory gate prices. Now, officials are blaming this on the hot temperatures, the heavy rainfall, but our Bloomberg economics team believes that there are more troubling factors at play. We're looking at stimulus that hasn't really been picking up steam, perhaps because local governments are saddled by heavy debt. We have Goldman Sachs writing that so far year to date, in terms of revenue from taxes and land sales, that may not be able to meet the projected budget this year, which means that government spending could lag behind, especially if there's no upward revision to the budget deficit this year.
What else needs to be done, particularly when it comes to the housing sector?
Yeah, the housing sector is still not looking very positive at the moment. The August preliminary data that we saw, sales were down 27%. That's compared to a nearly 20% decline in July. In some ways, this is not unexpected because we are seeing developers slashing prices heavily to attract home buyers. So those sales numbers understandably don't look very good. You also have some home buyers staying on the sidelines waiting for prices to bottom out. This is after at least 10 cities have scrapped or relaxed those new home prices, guidance prices from the governments, allowing market forces to determine prices here. But so far, we are seeing, the measures introduced by the PBOC back in May not really being enough to turn around the sector. And our Bloomberg economics team believes that maybe the government may be running out of measures to help turn this sector around. We previously reported that the government may be looking to allow mortgage owners to refinance some of their loans, about $5.4 trillion worth of that. But that's really equivalent to a mortgage rate cut, which the PBOC has been introducing in the second half of last year. And that hasn't really been enough to really turn the housing sector around.
Bloomberg's China correspondent Min Lo there. Well, Bloomberg has noted that China is considering letting homeowners refinance as much as $5.4 trillion in mortgages to lower borrowing costs and boost consumption. Let's bring our next guest who sees some pretty high hurdles when it comes to the successful implementation of such a plan. Zelina Zeng is a head of Asia Corporates and Asia Credit Strategy at CreditSight. Zelina, great to have you with us. So we've seen really incremental efforts to try and at least put a floor under the property sector, right? Is this latest development likely to actually create positive growth?
I think to some extent, at least this is a positive signal to the market because it shows that the central government is very much aware that the previously implemented property support measures have so far failed to rescue this slump of the housing market. To some extent, this is also a recognition from the central government that consumption needs to be boosted. And the first way of doing it is turn around the housing prices and to boost this animal spirit of demand for the housing market again. But I think the details here is a bit lacking. And in the previous round of support measures, the implementation has been not so effective. So I think we still need to wait and see what are the exact implementation mechanism for these measures.
Certainly high-yield property bonds have not been trading in a way that shows a real investor conviction here.
I think if you look at the price action over the past few days, some of the higher quality, high yield property developers such as your Vanke, State-linked, Jinmao, and some of the IG names are trading up slightly. But if you look at those lower quality ones, the price action is really mixed. I think this really reflected the market is lacking conviction in terms of how these policy support measures will go. Just because of the past 2 years, the government has pushed out a lot of policies, but the implementation details and the effectiveness is quite disappointing. I think to some extent we also share this view. We are slightly more positive towards the investment grade Chinese property developers in the dollar bond space, but for the high yield sector, we still see very poor risk reward.
Given that poor risk reward that you mentioned, are those the most vulnerable assets? The question of the day for Bloomberg today is what assets would be the most vulnerable in China's slowdown?
I think if you look at the China dollar bond credit space, this has been extremely resilient for a couple of reasons. The first is we don't have new supply coming to the market over the past 2 years. And if you look at the tail risk, it has been reduced, even though these government support measures didn't really help to rescue the continued default of the high yield property sector. But the contagion risk to the non-property sector has been largely contained. So because of that, the high yield China industrial dollar bonds has been trading very well. But I think if you're looking into the second half of the year, a lot of the investors are adopting a very defensive stance, and with the U.S. Treasury yields moving lower, the all-in yield for a lot of the IG names is also getting less attractive. So I think there is this downside risk that China credit spreads could maybe widen into the next few quarters.
And we're seeing really that reflected already in the data, right? I mean, manufacturing PMI numbers contracting for a fourth consecutive month, or at least in contraction territory. What are you expecting for the Caixin PMI numbers? Are we going to see that reflection and into broader eco data across China? I guess the question is also, will they be able to achieve the 5% growth target?
I think the growth target is still achievable because year to date, the export numbers still have been quite great. And into the second half of the year, the government do still have some fiscal stimulus measures. And year to date, we have issued about close to half of the special purpose bonds. So in terms of fiscal stimulus, there's still some room to go. But I think the property sector is still going to be the biggest drag on the economy. And the consumption, a lot of the measures are in the pipeline. But I think the effectiveness, we still need to wait and see.
Do you have a view on the yuan? Because we're now seeing the offshore yuan at the highest level this year, but I wonder if that's just a function also of what's happening to the US dollar on the other side.
I think to some extent, or to a large extent, this is because of the broader softness of the dollar. If you look at the Chinese yuan against the Asian currencies, it actually underperformed a bit. I think the PBOC still have this mindset that the yuan cannot appreciate or depreciate too much because on one hand, they need to take care of the export growth, and on the other hand, they need to pay attention to the capital outflow. Looking into the next few months, I think the broader weakness of the dollar might provide some support to the yuan, and the strength of the Japanese yen could also be an anchor strengthening factor in the Asian currency space. But if you look at the macroeconomic development, I think fundamental wise, it's not very supportive of a stronger yuan.
Lina Zhang, always good to have you with us. She's the head of East Asia Corporates at CreditSights. And of course, we're in the thick of earnings season in China, or at least we're almost done with it. 95% of MSCI China has reported earnings already, including many of the big banks and also real estate developers. And we actually saw 60% of companies missing profit estimates. This, of course, really doesn't help broader investor confidence. Of course, the Chinese market has been broadly pressured in the past year. The biggest laggard, real estate and financials, the only two sectors with negative growth. We actually saw a little bit of outperformance when it comes to consumer staples and communication stocks, Heidi.
We are just getting an alert crossing the Bloomberg when it comes to REA. This is, of course, the sort of digital advertising company. They run in Australia residential and commercial property websites. And we are hearing from REA Group that it is considering a possible cash and share offer for the entire issued and to be issued share capital of Rightmove PLC. Rightmove is a UK-based house price index provider. They have a website that lists properties across Britain, showing changes in house prices and providing some of that data across England and Wales as well. REA has not approached nor held any discussions with Rightmove regarding any potential offer, but we're hearing that REA Group confirming that they're considering a cash and share offer for the UK business. More ahead on the Asia trade. This is Bloomberg. Take a look at the latest corporate stories we're tracking. And Chinese automakers registered fewer electric cars across Europe in July. That says news tariffs amplify the impact of a broader slump in EV sales. Researcher Dataforce says brands including BYD and SAIC Motor accounted for nearly 10% of EV registrations. That's down slightly compared to a year earlier. New tariffs introduced in July raised duties on Chinese-made EVs to as high as 48%. Goldman Sachs is said to be planning to dismiss several hundred employees in coming weeks as part of its annual cull of low-performing staff. Sources say that would bring total cuts this year to around 3 to 4% of the bank's workforce. That's in line with Goldman's typical approach as it seeks to keep a lid on costs and make room to enlist new talent. Intel may reportedly consider selling its programmable chip unit Altera as part of a cost-cutting plan. Reuters cites a source saying the company is also considering capital spending cuts, confirming a Friday report by Bloomberg News. Our sources say other possibilities include a split of Intel's design and manufacturing businesses, with options to be presented to a board meeting later this month. Oasis fans rushing for tickets to the British band's first concerts in more than a decade overwhelmed the sites of Ticketmaster and other sellers. Fans complained of long lines and errors, many walking away empty-handed after hours of waiting. The 17-night UK and Ireland tour is the first since the band broke up in 2009 after years of infighting between the Gallagher brothers. Shery.
Let's get now to some market calls we're following today. Top-performing emerging market bond managers are recalibrating positions ahead of a likely Fed rate cut this month. Investors from PIMCO, Neuberger, Berman, and GMO are eyeing local currency debt and select reform stories from countries including Ecuador and Argentina. They say those two nations stand to benefit most from the boon the Fed cuts should provide to risk assets. Global investors also seeing boosting exposure to Indonesia and Malaysia. For more, let's bring in senior Asia equities reporter Abhishek Bishnoi. So, Abhishek, why is ASEAN becoming hot when, say, bigger rivals like China are so cheap and India also is witnessing a red-hot rally?
Hi there. So, if you look, India and Malaysia are seeing a lot of money coming in. It's the highest month-to-date flow in the month of August in about 2 years for both the markets. And rupiah and ringgit as well were, saw great outperformance among all emerging market currencies. Now, there are a few reasons for this. One is obviously the rate easing cycle, which is a bet on the world largely. Every market sort of gains when interest rates go down. But in case of ASEAN, these markets are better positioned than their rivals. And if you look, the region had been ignored for a very long time. I mean, the rise of China, the rise of India, but there hasn't been a rise of ASEAN. So, they're very cheap. They are very lightly positioned. And they are showing responsible fiscal behavior. If you look, the bigger rivals like China, they're problematic. China is going through a slowdown. They've not been able to fix the economy so far. And India is becoming very expensive. So in that macro context, there is some rotation as well from these two markets or, the new money that is getting allocated to Asia going to markets like Indonesia, Malaysia. Putting all that together, ASEAN is commanding a bigger heft in EM investing.
What does it mean for Asia allocation then?
So, if you look at the week till date flows, it's not just about Indonesia, Malaysia. Philippines is also seeing a lot of money coming in. We have also seen other markets in ASEAN, most of the markets in ASEAN seeing good flows. They've got their own, individual factors because of which they are gaining. Malaysia is also a bet on AI. Indonesia is seeing policy continuity even as the new leader has stepped in. All this means that ASEAN as a region would be commanding a bigger weight, likely. This also means there would be a continued rotation of incremental money from markets like China and India to ASEAN markets, Indonesia and Malaysia being the best stories there. And this is, again, a symptom of the growing aspect of emerging markets allocation, excluding China. China has disappointed investor strategists so much that they are looking at EM without China. Recently, Nomura downgraded China, citing those very reasons, and they used that downgrade to fund the upgrades of Indonesia and Malaysia.
Senior reporter for Asia Equities, Abhishek Vishnu there. More ahead on the Asia trade. This is Bloomberg.
The latest episode of Bloomberg's Tiger Money podcast features one of the best-known China analysts, Grow Investment Group partner and chief economist Hao Hong. Our colleague David Ingles asked him what the world is getting wrong about the world's second biggest economy.
So many misconceptions, though. We can go on another hour, talking about just to clear all the misconceptions. I think.
Well, what is one that you think
just the biggest one
is something that if people get over that, if people understand the nuance and that misconception disappears, we get a decent allocation back into Chinese equity markets from dollar investors.
Yes, the Chinese mentality of working hard and saving hard, I think it's very difficult to understand, because it's a cultural thing. It's been passed down for generations. Ever since we were kids, we were taught to work very hard and save very hard for rainy days. And so I don't think the Chinese savings phenomenon and as a result the overinvestments phenomenon is going to go away because of the tariffs. So I think that's a huge misconception. This is a structural. Sort of a structural peculiarity that cannot be fixed by tariffs and by all these trade wars and stuff. So I think if people understand that, then people will sort of think differently. Because for some of the foreign investors that I talk to, they seems to be seeing the Chinese overinvestment in the manufacturing industry as an action with malicious purpose.
Grow Investment Group partner and chief economist Hao Hong there, who we will be speaking to again a little bit shortly, live on the China Show. After that, you can get the full episode of the Tiger Money podcast on Apple Podcasts, Spotify, YouTube and Bloomberg.com. And new editions dropping every second Tuesday. Take a look at how we're setting up when it comes to the futures session. Sort of bifurcated trading session we're seeing so far with the markets that are open here in Asia. Quite a bit of caution. US futures looking a little bit to the downside there. TAIEX futures up by just about 0.1%. You're seeing that weakness continuing to probably play through to Chinese risk assets as well. FTSE 50 China futures down by about 0.4% as we really see the weakness in the PMI numbers. And we're of course getting the Caixin reading on factory activity this week as well. likely to continue to show that weakness. The property sector data as well when it comes to new home price sales also just steepening that plunge there. We are seeing some weakness when it comes to South Korea and Australian equities at the moment. Some of the miners not doing very well. Again, that reaction to the China eco weakness, but Japan stocks at this point looking a little bit better, Shery.
Yeah, which is why we're seeing a little bit of a divergence when it comes to Asian equities, right? The ASX 200 right now, as you said, we are seeing some movement in the miners, but the Kospi is down 0.2%, retracing some of those earlier losses, but we still have healthcare, consumer discretionary stocks also leading the declines, although industrials are up right now. Of course, we did get those export numbers out of South Korea, really returning to double-digit growth for the month of August. So we continue to see some strength in those semiconductors and automobile exports. But when it comes to the Nikkei, we're seeing healthcare and consumer staples also really dragging the market, but at the same time, tech gains are pretty strong right now. Materials and financials also leading those gains. So we're up about 0.7%. We're watching the Japanese yen, which is now a little bit steady after weakening for the past few sessions against the US dollar. Right, that's it for the Asia trade. The market coverage continues with Hong Kong, Shanghai, and Shenzhen. The China show is next. This is Bloomberg.